Imagine a city where every single water tap is controlled by one giant valve. If the operator turns that valve just an inch, the pressure changes in every home. Some people get a steady stream. Others find their pipes running dry. The operator does not own the houses. They do not fix the plumbing. But they control the one thing every house needs to survive. This is exactly how the European Central Bank, or the ECB, handles the banks of Europe. From a glass tower in Frankfurt, a small group of officials makes decisions that dictate the cost of a mortgage in Madrid and the price of a business loan in Berlin. They do not manage your local bank branch, but they control the pressure of the money that flows through it. By adjusting just a few key levers, they decide if the economy should speed up or slow down. Why should you care about a bank in Germany if you live in New York or Tokyo? The Eurozone is one of the largest economic blocs on the planet. When the ECB changes its stance, the waves do not stop at the European border. Global investors move billions of dollars based on what the ECB says about the euro. If the ECB raises interest rates, the euro often becomes stronger against the US dollar. This changes the price of every car, phone, and barrel of oil traded between continents. Central banks, like the Federal Reserve in America, and the Bank of England monitor Frankfurt constantly. If Europe's banking system becomes unstable, it can trigger a global chain reaction. We live in a world where a crisis in a French bank can freeze credit markets in Asia. The ECB is the first line of defense against that chaos. How does one institution actually control thousands of independent commercial banks? It uses three primary tools, often called refinancing operations. Think of these as the price tags the ECB puts on the money it lends to banks. First, there is the main refinancing rate. This is the interest rate banks pay when they borrow money from the ECB for 1 week. It is the benchmark for the entire economy. If this rate goes up, your local bank will likely charge you more for a car loan. Second, there is the deposit facility rate. This is what the ECB pays banks to keep their extra cash in Frankfurt overnight. If the ECB wants banks to lend more to people, it lowers this rate. Sometimes, they even make it negative. This effectively fines banks for sitting on cash, forcing them to move it into the economy. Finally, there is banking supervision. Under the Single Supervisory Mechanism, or SSM, the ECB directly watches the biggest banks. We are talking about the 100 or so significant banks that hold over 80% of Europe's banking assets. They check the books. They run stress tests to see if a bank would survive a sudden market crash. If a bank is taking too many risks, the ECB has the power to step in and stop them. You might wonder why the system needs constant adjustment. The problem is that the Eurozone is not one single country. It is a collection of different economies like Germany, Italy, and Spain. What is good for a booming economy in the north might be a disaster for a struggling one in the south. If inflation is too high in Spain, the ECB might want to raise rates. But if the economy is shrinking in Italy, higher rates could cause a recession. This creates a permanent tug-of-war. The ECB must find a middle ground rate that works for 20 different nations at once. Because these countries share one currency but have different tax laws and debts, the perfect interest rate rarely exists. This friction is why the ECB is constantly fine-tuning its tools to prevent the system from snapping. Not everyone agrees on how the ECB should use its power. Critics often point to the difference between the ECB and the US Federal Reserve. The Federal Reserve has a dual mandate. It must try to keep prices stable and keep employment high. The ECB is different. Its primary law, written into European treaties, is to focus almost entirely on price stability. Some experts argue this makes the ECB too rigid. They claim that by focusing only on keeping inflation at 2%, the ECB might ignore high unemployment in places like Greece. Other experts disagree. They argue that a central bank's only job should be to protect the value of the currency. They believe that if the money is stable, the rest of the economy will eventually fix itself. As we look toward the future, the ECB's role is becoming even more complex. The rise of digital currencies and global trade wars is changing how money moves. The ECB is currently exploring a digital euro to keep up with changing technology. They are also looking at how climate change affects the stability of the banks they supervise. If a bank has billions of euros tied up in industries that are becoming obsolete, that bank is a risk. The ECB is now asking banks to prove they can handle these long-term shifts. Their goal is to ensure that the pipes of the financial system do not burst 20 years from now. The decisions made in Frankfurt today will determine if the euro remains a global powerhouse or fades into the background. The European Central Bank is arguably the most powerful institution in Europe. It holds the keys to the continent's wealth and the stability of the global market. It operates with a level of independence that most politicians can only dream of. But this power comes with a heavy burden. Every time they move that giant valve of interest rates, they are betting on the future of millions of lives. They must balance the needs of a dozen different cultures and economies with a single mathematical target. In a world that is more connected than ever, we have to ask ourselves, can one institution really keep the balance forever, or is the system simply too big to control?